afternoon, and thank you very much for joining us today. Today we're talking about the industrial and logistics property sectors, which are red hot at the moment, due a lot to the pandemic, which probably saw 10 years worth of online retail adoption in about 15 months. And it's not unique to us either. I was on the phone this morning to a partner in Australia, and the same thing is happening there. They're seeing huge demand and not enough supply. And it's just the basic economics of demand outstripping supply, pushing prices and rents to record levels and compressing yields to numbers not seen before. And it's happening in all types of property, not just the big sheds, as you may expect. One of the beautiful things about this role is we get to speak to thousands, if not tens of thousands, different of property investors and developers. And I was talking to one on Monday, and they specialize in sort of secondary industrial units around Warwickshire, and they're seeing rents sort of increasing from £3 a foot to £6 a foot almost overnight. And obviously when you've got a multi-let unit, multi-let estate, that's obviously having significant gains in capital growth for them. And this is resulting in many areas where land values for logistics and industrial sites are much greater than residential, which may come as a surprise to many, but a bit more of that later on. But is it all a bed of roses? Will it continue? And if so, for how long? Well, to help me answer this, I brought along my guest speaker, Neil Slade, Director and Industrial Specialist from Harris Lamb. Hi, Neil. How are you doing today?
Hi, Simon. Good, thank you.
Perfect. And I've also brought along my co-founder and brother, Paul, to have a bit of a discussion around this too. Hi, Paul. You all right?
Hello.
Perfect. So Neil and Harris Lamb in particular have had quite a long-standing relationship. I think about 15 years. You've acted for the family property investment development business for quite a long time. I think you've done agency work. I still think you're managing quite a lot of the service charges across the estate and things like that. But I think we first met on our scheme at Cold River Park, didn't we, down in Tyseley in Birmingham about, I think, 14 years ago now. I think we all looked a bit younger back then, but that was a 70,000 spec industrial scheme back in the day, about a GDV of 6 million, I believe, at £85 a foot. I think we were shifting the stuff at £85 a square foot, but it was a very interesting one. I had fraught with a few challenges, but we got there in the end, didn't we? I think that was.
Indeed. Yeah. Good scheme.
It's still there.
It's amazing how 14 years later we haven't aged a bit, isn't it? It's remarkable how that's the case. Remarkable.
But anyway, over to you, Neil. Do you want to give us a bit of a background of what you've been seeing and since the pandemic and the rest of it, if that's okay?
Yeah, I thought we would sort of talk loosely on where we find ourselves today and perhaps give some justification for that and go back to the environment prior to the coronavirus, what the coronavirus meant to the industry and the effects of the coronavirus and how we've sort of lived our lives since, with specific regard to the industrial sector. So firstly, starting off as per the slide, sort of the negative impact of the coronavirus, that when it came through in sort of March time in the UK, in terms of lockdown in last year, it was on the back of some sort of pre-existing uncertainty, on the back of the general election. There was political uncertainty both within Europe and across the globe. The general election, big question marks over what a Labour government may have meant for the property and industry from an investment perspective alone. So that the market had stuttered along really 2019, and coming into 2020 there was sort of reason for optimism that we were going to see a release of the brakes from a occupational perspective and increased take up across the market, and that was seen in the early parts of 2020, and then we hit sort of February time, when the effects of coronavirus were having an impact on supply chain and such like. And then in March, lockdown, that was when we really started to see the problems. It led to, as per that second point, market paralysis. Businesses were so uncertain about what this meant that from a property perspective, no decisions were being made. So companies who would ordinarily look at moving from building A to B within a certain area, whether it be upscaling or just making use of the market, moving to better quality accommodation, winning new work, etc., the majority of those deals pretty much stopped overnight. So we were sort of looking at the floor, just wondering what was going to happen, both in the short, medium and long term. Developers, property landlord clients, property companies, investors alike, let alone businesses, were sort of all looking with immediate effects as to what it all meant. You know, where would we go from March, April time of last year? And the lifeblood of the Midlands market, the inquiries, the calls from occupiers to Harris Lamb and to our competitors pretty much dried up as well. So there was this cross-sector withdrawal. So it wasn't just in the, we're now seeing damage in the retail sector and office sector and such like, but it was across the market. We were not seeing any take-up of any note in those early parts of 2020. Coming out of the springtime, we started to see some slow take up with PPE contracts. So a lot of deals that were being done in sort of April, early part of May of last year were on the back of reasons for the NHS to be taking space, whether it be for PPE manufacturer, for storage and distribution purposes. But these deals in the main were short term. They were heavily incentivized. Landlords were trying to get rid of their buildings because they didn't understand or quite know what sector was going to come back and take these buildings on more institutional terms, and when and at what rent. So deals were happening which were perhaps under rented. They were highly flexible, 12, 18-month deals, 18-month breaks. Those were the only deals happening in the market predominantly. There was also the uncertainty going forward of future unemployment, businesses shedding staff, businesses tipping over, the government supporting, how long would it last for? And all these zombie companies that we were talking about through 2020, those that were pretty much supported by government packages, how long would they continue when that support stopped? And what that would mean for the property market in terms of the potential for increased void. And if you've got more void, then you would see that the opportunities for occupiers would increase on both capital values and rental bases, i.e. falling rents, falling capital values, more opportunity. And if we just click over the slide, if we may, this is the inquiry levels into Harris Lamb from early part of 2020, sort of April time, going through into 2021. And it's just an interesting review as to what I've just said, that predating that first April 2020, where there was approximately 120 inquiries that came in, which is markedly lower than what we'd seen in sort of January and February 2020. Now, 120 calls into the business, it's significantly lower than what we'd normally expect. And March was down on those numbers. But as you can see, there was a relatively swift rise out of the early spring going into summer. And these were predominantly in the logistics market. So initial deals were those PPE deals, those short-term deals, PPE, as I said, the 3PLs taking more space. And then there was a slow take up on the logistics sector with e-fulfillment. And going through 2020, those levels of inquiries stabilized around sort of 300, 350 inquiries coming into the office. So probably it's 300% of where we found it in April of that year. It dipped going into back end of the year. We're going to more lockdowns, but then coming back out into early part of this year, a second wave of better inquiries. And whilst we haven't got the data on this slide for this this presentation, but the inquiries have stayed stable at those levels. So through 2021, the amount of inquiries into our office has remained very strong at effective record levels, even though we've seen significant take-up in the sector. So we can jump on to the next slide. So the positive impact of coronavirus, that initially there was this call to arms, as I said, desire for landlords to be offering deals for PPE storage and such like, and those are the only deals being offered at the time. But there was that change in landlord sentiment coming out of the spring, going into the early summer, and that is predominantly down to the e-fulfillment sector taking up significant amounts of space in certainly the Midlands, but not across England and beyond. We've just heard that it's happening elsewhere in the country and across the globe. That's because we are doing things differently as communities. We are, as individuals, shopping more online. What's happening is that there is more products being stored or coming into the UK for instantaneous delivery. We're no longer expecting to wait 2 or 3 weeks for whatever we're ordering from an Amazon or an eBay or any other platform. We're expecting now to have those goods on our doorsteps within 24, 48 hours. That means that the products need to be within the country. So there are more requirements to hold or stock hold within the UK, which means more warehousing. Because we're shopping online, there are more last mile delivery requirements. The Amazons of this world are getting bigger and bigger. E-fulfillment sector as a part of the logistics, part of the industrial market is now, I think it's accounting for sort of north of 80% of the deals done in the last 12 months. So that change in landlord sentiment happens relatively early within 2020, that the damage on the industrial sector was going to be relatively minor. 2020 itself was predominantly made up with logistics take-up, but 2021 has seen much improved sentiment with SMEs. So buildings sub 100,000 square foot have been taken up this year to the point where there is record low supply. So all of this happened on the back of Brexit. It happened on the back of a relatively stable political environment. So there's nothing to suggest that what we are experiencing at the moment is going to quickly peak and tail off, that there may be a relatively, there could be some degree of stabilization over the coming years, but there isn't any suggestion that the market is going to see a falling away of demand or capital values and rents. And that is compounded and underpinned by the demand from both investors and developers who are looking years ahead. So this long-lasting change in consumer habits is ultimately underpinning where we are, that the industrial market has become a bigger part of all of our lives. What this has meant is that we have seen in the last sort of 12 months record rents being paid. We were looking, for example, in Birmingham, prime rents 6 months ago, £7.50. We are through and beyond £8 per square foot. We are projecting rents potentially going into double figures, and that is it is a projection. And when I say double figures, that's already being achieved on certain types of industrial property in terms of trade counters and smaller industrial units, but mid-box industrial, in terms of where land pricing is expected to be, in terms of where yields are, let alone build costs, but to make some schemes viable, rents may well have to get up to those double figures, which will be record growth in a relatively short period of time. Capital values follow accordingly. The yields being paid now, prime industrial yields in and around Greater Birmingham, the Midlands, we are regularly seeing sort of 3.5%, and that is being bettered still. So we're getting close to 3% now for prime industrial yields. Demand is unabated. The take-up has been such where we have no existing supply of certain types of property in the Midlands at the moment, and that's not simply logistics buildings. Those are mid-box industrial units of certain sizes, those are trade counter units, those are starter units. It's across the board. So we haven't seen the release of industrial property. We haven't seen zombie companies go to the wall. There have been some casualties. There have been some sectors of the industrial market that have struggled, but by no means have we seen anything like the the potential damage that was being forecast in the spring of 2020. So the only holding back of the market is the market itself, in terms of being unable to satisfy the demand. So the pipeline of industrial supply in the Midlands is weak, and there's very little coming through. So on to sort of future opportunities and targets. And this is more sort of how we as a business are looking to operate, that, and this is where Nimbus can help, is that development land, strategic land. I mean, that's always been very much our focus, but the market's focus to deliver the next industrial site, whether that be of magnitude or infill. But it is required across the board. We are in desperate need of infill sites of 1, 2, 5 acres. We are in need of sites of 10, 20, 50, 100 acres. There are some sizable requirements in the Greater Midlands that are unsatisfied because of lack of opportunity. And the industrial market is currently the sector to be in. The yields that are being paid, the expected medium to long-term stability and growth, it's all looking very, very positive. Just spoke about the increase in void in the short term. It's not being seen at the moment. There are no hiccups, no bumps in the road that we can foresee. There's nothing to suggest that there will be a slowing down in the industrial market other than that lack of supply. Short-term lettings, again, the market has changed. There's nothing to suggest that there will be anything other than long-term growth and relative aggression from a landlord's perspective. Long-term leases are vogue. Very little on the table now for occupiers. In terms of how we're trying to find sites, the market itself is scratching its head, but we are looking at opportunities such as creating bigger, better, more modern industrial out of older industrial sites. But that in itself is a problem because of the values. In older industrial, invariably it's very tight in terms of what these sites ultimately will be worth and what a developer can pay for them once they're all cleared up. We are looking at inner city urban logistics, trying to find again sites for a number of occupiers. We're looking at changes of use from retail warehousing, such as the demand there, and there's a bit of opportunity around. But it's all under a barometer of investor, landlords, occupier, growth, sentiment, demand. It's very healthy.
That's it's extraordinary, because you kind of got, I love the graph of the sort of inquiries coming in, because that's sort of, it's a fantastic barometer of people making, that the demand is still there, and it keeps coming through. But
yeah, I mean, we've got I mean, not just our business, the occupiers are looking around the market, talking to various agents, but there are a high number of very good quality end users looking for space in the Midlands that they're struggling. The buildings simply aren't there. There has been approximately 5-6 years worth of take up in the last 9 to 12 months. Mm-hmm. So buildings that would invariably be on the market for 6-12 months, we're just seeing a lot of pre-lit activity now. Buildings that are going above ERV. It is unforeseen, and the market is playing catch up in terms of replenishing the shelves, and occupiers are struggling. Mm-hmm. Certainly those in the logistics sector, those who are winning more work, there's more demand for warehousing, but the property opportunities are not, they're not there like they were, certainly.
But the retail, as you said, the retail adoption of e-commerce is not abating, is it? There's more and more stuff going online, so that's not going away. Those companies are growing at record levels, aren't they, still? So that's just continuing to demand space. That's not going away, is it, anytime soon? Which is just the market can't keep up, can it? Can't build fast enough to keep up with the demand curve, can it?
I mean, there has been some significant take-up in the e-fulfillment sector in the past 12 months, and that sort of goes on the back of what Amazon were doing, you know, as a single example. But there are more regional examples that have happened in the Midlands. You know, there was a company who started out in Cannock not too long ago in 30,000 square foot, and in recent years they're up to you know, thinking of 2 million square feet, and that has predominantly come through since coronavirus. Wow. And that is shipping finished goods from China predominantly into the UK, being sold on various online platforms, and their demands, you know, their growth is it's not, they're not taking a foot off the gas. You know, I think the only hindrance to them again is the lack of opportunity in the market from a property perspective, because they have got the requirements, and that's just one occupier.
That's extraordinary, isn't it? That's
yeah, and it's, you know, down to, it's not just, you know, larger logistics and urban logistics, mid-box. This is down to small starter units as well. You know, we've got various multi-let industrial estates that you know, Harris Lamb have been quite successful in dealing with over the years. You know, we've got a number of estates of magnitude, you know, millions of square feet on some of them. You know, one in Worcestershire, which is thinking of 2 million square foot. There's one in South Birmingham of 1 million. Yeah, and several hundreds of buildings on these estates, and both of those estates are fully let for the first time ever.
Yeah.
There's always opportunity on those estates. Buildings turn over quickly, you know, businesses come and go, they reach lease expiries. But what we've seen in the last sort of 6, 9 months, 12 months is that there's been very few businesses that have tipped over, but more importantly, businesses that have renewed, paid record rents to renew on estates, simply because the lack of opportunity in the wider market, and that they themselves are confident in the future. So it's great news for landlords from an agent's perspective. It's a challenging time because you need the product, but it's very strong.
The different challenges from, I said, April 2020, but there's still challenges to keep momentum going if you've not got the
I think complete change. Yeah, I mean, the market did not foresee in April 2020 where we are today, and that's proven by the deals that were being done at the time. Yeah. So, you know, good quality industrial buildings in the Greater Midlands of, let's say, 100,000 square foot, you could pick up below ERV, and you would be able to achieve highly flexible terms, you know, with 12, 18-month breaks. If those same occupiers haven't already renewed on those buildings for longer terms, they have. I don't think there have been many examples of those buildings coming back to the market and not going with immediate effect on longer terms. So those, and on better rents. So if a deal was happening at £6 per square foot with a 12-month break in April 2020, that same building would have gone on a 10-year lease at £7 per square foot. Yeah, that as an example as to how quickly the market has moved in 12 months.
Well, thanks. That's really interesting. Now, it's superb. But I think I'm not sure whether Paul was just changing a few numbers in the background, because last time we talked about this, we were talking about residential land values versus industrial, and against that tipping point where, you know, you can outbid residential, which was probably the default solution for any bit of land, is like, let's go and put some housing on it. But of course, with this calculation, and I know that Paul's been working on a calculation, but I think I can almost see in his mind that you're going £10 a foot, 3.5% yield. So that's 300 quid a foot. So you might have just, I could see him beavering away in the background, and I think I could probably tell he was just changing a few things. But we were just going to perhaps, Paul, put a slide up about how you can sort of see how those land values can outcompete resi in sort of, you know, in terms of certain locations. But I think you did a.
Sure. So what I was just doing is I feel like I take on the role of the nerd here, which is just to kind of try and bring together or bring to life some of the numbers that are kind of being talked about. So I went off and got my big book of Spawn just to kind of look at what the kind of estimated build costs are at the moment. So I ran a little look through that book, which said that light industrial buildings from Spawn are talking about £670 a metre to £860. So I assumed a mid-range spec, assuming the West Midlands, that brought that down a bit. We're a little bit cheaper in the West Midlands than we are across the rest of the country. So about 86% of normal. Inflation to assume a start on date for 2023. In my head, I'm thinking about like a £2 million scheme, kind of a couple of acres kind of thing. So I sort of adjusted it for that as well, added some contingencies and professional fees. And that book came out with an £804 a square metre build cost, all in, including contingencies and professional fees, no abnormals, but sort of a sensible kind of starting point, which is about 75 quid a foot, which obviously quite expensive compared with the stuff that we were building sort of a few years ago. But that's what the book was saying. And then to compare that, what I then did is look at the same calculation for a similar residential scheme. So assuming we've got the same site in effect, what's that build cost for residential? And there's been some, obviously as part of COVID, there's been some extra kind of inflation that maybe sort of the inflation needs to go ever slightly, but in effect is giving us a sensible position in effect. And so for a like kind of scheme, we'd be talking about 1750 to 225, £2,225 a metre, again from Spon. So I assumed a mid-range spec for the resi as well, which gave me £2,000 a metre, and then applied the same calculation. So actually kind of took a little bit less of a discount because of the contracts, and the residential scheme a bit bigger than the commercial scheme, kind of more expensive, and therefore you get a bit more economies of scale on the residential scheme. But adding my contingency and adding my professional fees on, that gave me just a tickle over £2,000 a square metre as a build cost, my residential scheme, which is £191 a foot. So kind of like for like, same book, same values, same assumptions. Those were the kind of the two relative values.
If you're building an industrial scheme on that acre and building an industrial residential scheme, that's the sort of build cost. Yeah,
absolutely. So that kind of gave me some helpful stuff. And then what I did is I didn't change it, actually, although my brother alluded that I probably should have done. I assumed this. So I then said, well, actually, if we assume a 2-acre site, then what I was expecting to hear from Neil was actually kind of, he said more stronger stuff than I was kind of expecting. So I've assumed a 750 a foot letting level for this assumed site, 2-acre site in effect. And I put a 5% net initial yield against that, which gave about 140 quid a foot as the value. I then knocked off 25% return on cost for a sensible developer's profit, and then used that £73 a foot build cost in effect. That gave me about 40 quid a foot land value as a sort of sensible starting point. I then said, well, actually, if I get about 40% site coverage, what I kind of usually expect to get on a shed scheme, that would give me 17,500 feet an acre. So it would give me about 700 grand as my land value. I then said, well, actually, what about if we get a £250 a foot area? So an average sales price of £250 a foot, and that would kind of put you in some of the swanky parts of Coventry and this sort of stuff. So kind of the West Midlands, sort of reasonable parts of the country and this sort of stuff. So that gave me kind of probably a GDV of about £300 a foot. I then knocked up my profit, put that build cost in as well. That gave me a gross land value of £48 a foot, so a tickle higher than the net land value. But of course, on a 2-acre site, I'm going to have to pay some affordable housing on that. So I assume we've got a nice council here of say 40% affordable housing rather than 50% affordable housing. I'm a 2-acre site, so I'm probably doing about 40 units or something like that, 35, 40 units or something. So I've got an affordable housing and a big chunk of that going off from my land value, which gave me a net land value of 30 quid a foot. And if I then think, well, I'm doing 2-storey housing, sort of normal 2-storey housing outside London, I get about 14,000 feet an acre on that, which meant that my land value was £407,000, which is less than 2/3 of what the shed value is like for like, which really quite surprised me. So I then thought, well, actually, given that I'm a nerd and that's my role today, what I then thought was actually, how does that then compare? If I then say, well, if I want to get the same land value based on that calculation, what quality of area do I need to go for? And the answer was £350 a foot sales value. Now, for me, that gets me up to kind of Lichfield and to Sutton Coldfield and those sorts of areas, where actually if I can drive those sorts of values, and actually if it's 3.5% rather than 5%, I'm a bit light. It's more like £200 a foot rather than 150. We can now start to see why it is that we're suddenly finding the land values clearly stack up for sheds better than they do in resi for an awful lot of the West Midlands, quite frankly, because that 350 a foot, we'll show you in a moment in terms of which areas that looks better than, and kind of So whereabouts are we talking about? And actually what we'll find is that a big chunk of the West Midlands, the calculation over shed is actually more attractive than the one over residential for that size scheme.
So when we're looking,
So
like
kind of,
Neil was saying, like 1 or 2 acre sites, those infill plots, those infill sites which traditionally would have had said the knee-jerk reaction is it's got to be a residential scheme. That's always the highest land value, and that's the sort of utopia that everybody's trying to go for. It's not correct. It's that you know, we can look at this and go, actual fact, there's a clear demand, there's a clear thing, and that tip over valuation of a residential value is quite high, where industrial actually outbids it. Then in terms of that.
yeah, and
just to quickly jump in, you know, we've looked at some sites that are either residential developer tied, that they've got in land banks. We've also looked at sites that have gone through the planning process for residential, and those sites today are being promoted for industrial. From a financial exercise, it works for industrial, it doesn't work for residential.
Yeah.
I think the numbers that were on the screen there, I think you certainly £7.5 per square foot, subject to where this site is, of course, you know, but the net initial yield, again, subject to where it is and what it is, you know, can be improved upon. And I think that's what is ultimately having to, you know, the yields have had to move significantly. As they get harder, the rents are being pushed out. If you can find prime sites, industrial for 2 acres for sub 700,000 an acre, if it's decent in, say, Birmingham or a Coventry, you've done very well. Yeah. And a build cost of £75 per square foot, you know, I think you're close to 100.
But your top line's going up quicker than your cost, isn't it? That's the thing. So that's where you're pushing that. You know, you were saying nearly a 7-figure land values per acre, aren't you? That's you know, it's going. I mean, the top line's going quicker than the costs are going up, aren't they? That's the thing, isn't it?
No, you know, it's. I'm sure developers will all run different appraisals, and you know, that's the joy of the market. But you know, the end results. You know, if you take Birmingham, to my knowledge, there are no deals done to date in Birmingham of £1 million an acre. But the next deal or the next few deals, you wouldn't be at all surprised if it goes through £1 million an acre and ends up at something which is potentially closer to 2. Yeah. That's, you know, that's the market talking in terms of where land values may end up, and the only way we'll get there and make it viable is if these headline rents move considerably. Yeah. But I think we have to take it in the context of not simply what's happened in the last couple of years, but what hasn't happened in the Midlands in the last 15 or 20, that there's been relatively weak growth. So for the first sort of 15 years of my working career, the headline rents, you know, were probably 50p, you know, from point A to B. Yeah, they didn't grow significantly. And you know, compare the Midlands to other areas of the country, certainly the southeast, but even if, you know, the northwest, you know, that there is, the Midlands has been lagging behind, but it's coming back and coming back quickly. Yeah, but it's the numbers are there to sort of show how it can work, isn't it, Ray? But it's
yeah, well, little nerd here is just kind of replumbed those numbers back into his little Excel spreadsheet that I was going to show. I thought that my brother's face.
I could see you typing away as Neil was talking. He's like, oh, quickly, I need to change my appraisal. Yeah, yeah. But you know. So
what I've done is I've put in 3.5% and £7.5 a foot. Basically, it gives you £205 a foot sales values in effect. So sort of 200 quid a foot there. I've then put in £100 a foot build cost, and that's given me a net land value of, as you say, over £1 million quid. It's actually come out at 1.1 on this. Obviously, lots of assumptions around all of that. And then I suppose just comparing that back to where this needs to go. So on the same assumptions, then that then means that you're going up to £400 a foot in terms of your GDV sales value. So an area that's probably £330 a foot, the average sales prices is still going to be more viable to do.
It's probably almost peaking out that the resident. Yeah, it's an interesting one.
Yeah, it's pretty mental in terms of where those numbers stack up, frankly. So
yeah.
So yes, and maybe.
So the moral of the story is, I guess, at the moment is how do we find those opportunities, isn't it? And how do we sort of meet that sort of demand? So I just wanted to run through a few little bits here, because I think we obviously, again, the beauty of what we're doing today is we talk to a lot of people and I guess how they do find stuff. But I guess for us, from our background in property, and there's sort of three ways to find opportunities. One is your traditional on-market stuff, but I guess that's snapped up fairly quickly. That's kind of like, you know, yourself, Neil, putting the stuff on the market. It's your select boards, it's on a, you know, some websites, can be auctions and stuff like that. But then we kind of have this sort of off-market sort of pitch, don't we, where for us that's kind of twofold. One is I would say traditionally the version 1, which is where you've got very strong relationships with you, like yourselves, Neil. So, well, you know, if you've got a, you know that somebody might be selling something, you might get a nod on something, they might have gone and rent review, and they might have just put a new 15-year lease in place. There's sort of key trigger points within a investor's life cycle or a landowner's life cycle, so they might get knowledge of it, and then you could perhaps go to a few of your local developers and investors and stuff. But also I think in the current marketplace, and this is for agents as well as buyers, is maybe generating your own leads, your own site finding, digging out the stuff yourself. So, you know, if there's not enough supply, go and find those schemes and opportunities, land or industrial stuff yourself, and actually go and you know, I guess shuffle the leather on your feet, on your shoes, and go and do the sort of the site finding yourself. Now, so there's that sort of version 2. We did a quick poll, didn't we? This is a few months ago, but we sort of said just on LinkedIn, how do people find sites? How are they finding those opportunities? In actual fact, it's kind of an even split. Obviously, the on-market stuff is quite challenging at the moment because the stuff gets snapped up, whereas the off-market through agents and the off-market direct to owners is sort of a 50-50 split, sort of 45% and 46% across that. It's only a small sample, so you're really sort of seeing a lot more off-market stuff, and that's that friendly agent to that sort of director to sort of owner, and again it's the agents going directly to the owners and the underbidders and stuff like that. And I suppose it's looking at those, the pros and cons of those as well. So just as a quick thing, one way to do the direct to vendor stuff, what's the difference? Well, on the market, you've obviously got a willing seller, open pricing, but obviously it's highly competitive if it's a marketplace where there's a lot of demand and not enough supply. You obviously, it's the race to the bottom on the sort of profits, often, you know, low conversion rates. You might have to look at, you know, I'm hearing, you know, like James said today, you know, you're getting 9 underbidders on schemes and stuff like that. So, you know, you can put a lot of time in and you can keep losing out. You get emotionally attached almost to the deal if you're not careful as well, because the number of times you keep getting told you can't have something, the more you want it and stuff. So you can get a bit emotionally attached to that sort of on-market stuff. I guess the off-market, if there's not enough stock, it's challenging to get that sort of off-market stuff. But again, it's passive. You only can see what you can, what's on the market, or what's actually not on the market, what's coming through the pipeline and available to you. It's off profile. It can often be off profile. It's not particularly scalable, and it can be misaligned. It's quite difficult to get in the exact alignment with what you want. And I suppose then it's just looking at, well, what's the alternative? If those 1 and 2 aren't working, what is the alternative? Well, the alternative, I suppose, is this sort of off-market, either, you know, find out of the data, out of the opportunities, what you're interested in, shortlist those, and do some work on that narrower shortlisted scheme. So if I'm looking for a 20,000 square foot secondary multi-let industrial estate, go and find that, and then go and find several of those, and then either write the letters, or you can go knock on the door, or go to the agents that you know act for them. So if Neil's acting for somebody on a letting on that site and you're interested in that as a site, go and ask Neil, because he's going to have the conversation with them, and you can always go and, you know, and I'm probably obliged to put that offer through to the owner anyway, because you feel like you should be putting it through. So what we're trying to say is there are ways in which you can find what you want, and then go and look to that. And then that's also looking outside the box, and that's what I'm saying. The property industry is super entrepreneurial. It's kind of like, well, we have a demand. I can't get the supply for the demand. I need to think outside the box. You know, no pun intended. But, you know, you're looking at retail boxes. You're looking at, I mean, the mother care around the corner from us is being knocked down and turned into a Lidl. I know it's retail to retail, but you need to think outside the box. If there's no demand for these big white box, you know, units for the retail, then you can convert it at these rents, or look at residential and look at the different land values and that. So you can sort of have a broader, I suppose, more scalable target list, but of course there's also the challenge that they won't necessarily want to sell to you. So you've got pros and cons with everything, but I guess if there's nothing under 1 and 2, you know, on market and off market through the energy units, then you've got to go out and find those opportunities through this sort of off market site finding. And I guess that's where perhaps, Paul, you can come back on Nimbus. That's probably for trying to help the marketplace achieve when there's a significant lack of direct opportunities and stuff like that, if that makes sense.
Yeah, sure. So I suppose what I want to do is just kind of just try to bring to life some of the stuff that we've talked about, and sort of perhaps, I suppose, first off, look at, well, we've kind of quoted this figure of £330 a foot or £400 a foot for new builds, resi, and kind of, well, where does that apply and what does that mean in terms of, well, where can I viably or sensibly expect to outstrip resi land values for a shed scheme? And so first I wanted to bring that to life. I wanted to bring to life in my head this sort of the comment that Neil's been making about looking at kind of tired old sheds and perhaps repositioning them. I guess, you know, buying a shed that was at £1.50 now at £3 a foot, kind of giving it a decent sort of higher eaves and sort of giving it kind of a better look and feel to it, probably has some quite big impacts in terms of rental. In the old days, you know, you could take a £1.50 a foot shed and make it kind of 4 or something like that. I guess that may still apply. And of course, then if we're talking about sort of maybe, I guess, if that sort of stuff, maybe 4 or 5% yields, then actually the kind of those growths in values are actually quite high. So I sort of wonder if there's a bit of that we could have a look at as well, kind of where have people been buying sheds quite cheaply, and that we could actually perhaps give them a lick of paint, i.e. reclad them or something like that, or and kind of just improve the estate. I mean, kind of some of that's kind of going through my head. But equally, kind of where are those residential schemes? What can we go and find as part of that? So let's stop waffling and let's just get on with this really. So this is the Nimbus Maps Elite platform. And in essence, what I want to do to start off with is just start to bring to life some of this stuff. So first off, and in fact, they have this kind of a golden rule in technology, which is never demonstrate a live system in front of a live audience. So this is our live system. And there's a sort of an even more golden rule, which is never demonstrate your test site in front of a live audience. So this is our live site. I'm actually going to show you our test site. So I've broken all the golden rules here. My tech team are going to go mental at me when I do this. And the reason I'm doing that is we've got some really cool new stuff that's coming out next week. So the cool new stuff that's coming out is this thing called location analysis here. And what you'll see on here is 2 bits. So firstly, the comparables. I'm going to use that in a second, just to kind of understand what sheds are selling around Coventry or Birmingham, this sort of stuff. But before I do that, what I want to understand is if we're looking at residential values in a particular area, kind of what does that mean? Where am I able to look for land for sheds, where it's going to stack up, and where that appraisal that we've put together kind of works in effect. So the first thing I can do is I can do this thing here. So I can toggle on this average residential values in effect. So I can very quickly look across the Midlands, and we've got this kind of average number, about £330 a foot, which is going to give a sort of a residential land value about £1 million an acre, which then is in line with this sort of £750 a foot and the sort of the 3.5% yield that we're talking about. And I suppose if we think 330 a foot is our magic number, which it is, then you can see all these kind of areas all across sort of, you know, Birmingham, places like that, that there's really only kind of central Birmingham that actually gets anywhere near going above that number, quite frankly. You know, bits around Knoll and Bentley Heath and this sort of stuff. So I'm not going to be competing with a scheme in Rowington, but I certainly can across most of Birmingham, even into nearly kind of Harborne actually is kind of almost working. So you kind of think, well, Harborne, I've, you know, no chance of me kind of out competing a scheme around there. But of course, actually it does stack. And so there's some really interesting things, you know, lots and lots of Birmingham, all kind of around where the industrial areas kind of, I guess it's not surprising that that's the case. But then as you come across into Coventry, you know, if it is a well-located scheme in a good part of Coventry, you know, kind of South Coventry, Earlston and places like that, these are at 250 a foot, nowhere near the 330. They're kind of 20% below where, or 30% below where that kind of ceiling level is that we're looking at. So really kind of, I suppose if I sort of take a step further back as well and sort of look at, well, whereabouts is actually above that £330 a foot. There's not really many parts of the West Midlands that really are kind of getting to that level, which I think is kind of interesting, really. That was the first bit. I suppose the second bit then that I sort of need to try and bring to life is that, well, that's all fine and good, but we need to be able to understand, well, where are those residential schemes? So if I'm going to go and target a big residential scheme and I want to see if I can outstrip those, then what's kind of interesting is in the Nimbus system, we have this thing called the planning overlay in effect. And what that does is it overlays planning into the map. It's perhaps not surprising that what it does in effect. But what this is then showing me is it's showing me where are there planning applications for residential applications. So in effect, it's looking at the planning application, it's reading what the application's for, and it's saying, is that residential or not? And then looks at the size of that application, see, well, what is it? How big is that scheme that's going forward in effect? And then from that, it also says, well, kind of how new is it? So it sort of fades it out as it kind of gets older in effect. And so this is kind of completely live. I've not sort of checked this out. Maybe I should have done before I kind of got on this webinar in effect. But so I have got lucky. You have to believe that this is the case. There's an outline planning application near Prologis Park for 500 units, submitted in 2019. And actually, in my head, when we start then looking at those versus those residential values that we've just been talking about, we can see then how that is in a £200 a foot area and that shed values now. My guess is when that application went in, this kind of conversation wasn't a thing, because we're talking £6 a foot, we're talking, you know, decent shed, maybe 6-7% yield. So we're at £95, £100 a foot, perhaps tops. Now we're at £200 a foot. This is a very different position that particular site would find itself in. I think some of that might help perhaps open our minds to kind of what's out there. And I guess there's probably another one over there. Let's go see what that one is over there, just see whether this is an easy thing to do or whether this is more challenging or not. Let's have a quick little look down what we've got down here. It's slightly older. So that's actually got refused. Yeah, it's 107 dwellings. That got refused in 2016. I mean, I guess that could be interesting. Is can't have new dwellings there, but can I have employment space there? Well, that could be a different discussion with the council in effect. So I think there's kind of some interesting things that perhaps could come from that. And there's sort of another way of interacting with this too, which is to look at a thing called the planning export here with Nimbus. And so what this allows me to do is to search across Coventry. In fact, let's go big show. Let's do Birmingham at the same time as well, and just see. Assuming I can spell Birmingham, that'd be kind of helpful. So what this does is it allows me to go off and search across Coventry City Council's website, which is this first bit here, and Birmingham Council website at the same time. And it allows me to search for keywords. So it says, what keywords would you like to search for? Well, I want to search for residential, C3, flats, houses, apartments, dwellings, and that stuff. And then it allows me to remove stuff that's kind of not going to be relevant. So I don't want to see discharge of conditions and this sort of stuff. I want to see outline applications, detailed applications for genuine residential development in effect.
Just to be clear, Paul, so this is harvesting every single planning application every hour, every change every hour, 24 hours a day from 426 local authorities, and we're then taking that and categorizing it into a classifier of granted, you know, all those statuses. We classify that into those sort of different things for every single planning.
And it maybe I want to kind of filter this to number of units. Maybe I want to kind of do I want to see stuff that's over. In my head, it's probably 10 units, because 10 units we're going to get above that affordable housing threshold, which means then the land value is going to drop, which means that my shed values then are higher than that. So it's probably this that I'm looking for in effect. And so what this will do, will go off and it'll check for all that stuff. It'll run around in the background and go and find all those planning applications that have had those types of applications submitted on them. Give me a list of that. It's then going to link it through to the owner's details for me. Well, actually, in some cases, tell me what they paid for it, who it is, and what they paid for it in effect. So this then perhaps is also going to be interesting. So we can start then working through this, saying, well, actually, how big were those sites and what did that look like? And I think here we have, I've done it on the test site.
You have to reshare your screen. Yeah.
Do I? Is it stop sharing?
It's not showing the Excel file. No.
Apologies. Yes. What's happened is I've done it on the test site, so I need to do it on the live site, which is where they say never use your test site on a live webinar, isn't it? So I will rerun that for you, and then we'll see it on the live site instead. So apologies for that. So I think all that's kind of useful. When that kind of downloads, I'll drop that and just sort of move back to that. But I suppose the second bit that I thought was probably interesting was then looking at where do we find those buildings that are at that lower value use, kind of where they've perhaps sold at a £100, sorry, like £30 a foot or something like that. So I could actually probably bid a bit more than that, refurbish it, improve it, benefit from these kind of decent yields and stuff. And actually, there's a couple of things that are perhaps useful here. So we have this new thing, which is the commercial comparables. So what this is showing me is that there's a number of industrial, so I've just pre-filtered this at the moment. I sort of see across Coventry, there's a number of kind of industrial buildings that have sold. And I can then go look at the details of each of those. And actually kind of in my head, there's perhaps some interesting stuff around kind of how big they are. And this was a 23,000 feet there sold in Coventry for 675 grand. And so actually perhaps some of that stuff where it's so cheap, kind of 30 quid a foot versus a decent scheme being much higher than that could kind of be interesting. So that I thought was probably quite helpful. I'm just going to open this up again and just see what that looks like. So
just be clear that this comparables is coming out next Monday, isn't it? So this is new. This is a release that's coming out. That's why you're showing the test site, because it's literally just on
absolutely. And this is then from the live side. This is the bit that's kind of interesting. Really. So this is showing me then. So here there's an application for 499 residential units here. This is obviously in Coventry, and that then means that particular site then could be much more interesting as a shed scheme rather than the sort of the residential scheme that's proposed in effect. So it's kind of a number of bits that kind of could be interesting around that. 262 units there, 115 units down there. We sort of see this unit number down here in effect. So I think sort of a number of interesting things that we could perhaps try and pull out of that to sort of target owners of those particular sites. I suppose that perhaps is useful. I suppose the simplest thing then, and maybe I perhaps should have started with, but I kind of got all excited and wanted to show some kind of cool new stuff in a test site that I shouldn't be doing, is then I suppose at its most simplest is saying, well, actually, if I want to go and find pieces of land that are 1 to 5 acres where we were saying there's kind of this sort of infill opportunity, lots of demand for that sort of stuff. Then what you can do with Nimbus is you can actually apply a search for a certain distance from a particular location. I'm going to stick search in a moment and say, well, show me all the properties within half a mile or half a kilometre or whatever of this particular location, and just show me all those properties that are in essence at 1 to 5 acres, because that's where we're sort of seeing some opportunity in effect. I can then click apply, and the system then will go off. And that's just gone to London for me, so I haven't got that set. Give me 2 seconds. There we go. So this has then shown me all those properties that are then of that size where there's kind of this opportunity to unlock some infill opportunity in effect. So if I then just have a look at this, something down here is kind of interesting me actually. So you've got this sort of small building here owned by Highdown Trustees Limited. So they've owned that since 2006. They've actually sold 5 properties in the last 18 months. It's on an acre site there, and in my head that looks a little bit small actually. So there's 8,000 square feet on an acre. In my head, 40% site coverage on an acre site, which being about 16,000 feet on a site in effect. So that's kind of got half the size of building that I would kind of expect to be able to squeeze on it in effect. And so sort of quite quickly I can sort of zone in and say, well, where are those properties that are big enough for the requirement that we've set, so 1 to 5 acres. I can see who the owner of that property is. Highdown Trustees Limited is the owner. And click on the link, I'll take you through and show some details around that. My guess is they're actually a dormant company, and that's kind of interesting. There'll be some people behind it we can go and get in touch to go right to the owners of the property here. So Mark Ashfield is. Well,
he's an accountant at HBO, so I think it's an accountancy firm holding it as a trust, isn't it? So
I see, interesting. Yeah. So we can kind of get in touch with them to see if they we Google that then and
I think another one part I just say is like the sort of master map view gives you a nice clear sort of clears a lot of the white noise out as well, so you can just look at the buildings.
Yeah, sure.
There.
This is a slightly painful subject actually for me and Simon. So there's a site that we had in Warwick actually, kind of one of the sort of decent industrial estates there that we held. And actually, when you look at that particular site, and indeed these sorts of sites, I suppose what it's showing is this is the master map. This is kind of what people know as a pro map in effect, and in essence, it's an ordnance survey product. It sort of shows you a lot less clutter in the map in effect. So if I kind of switch between the two, you'll sort of see there's lots going on. There's stuff outside. There's kind of stuff that's kind of distracting me as I kind of look at it. When you switch across to this, you get this kind of very simple view of the world, which shows you how much building can I get on a site and how big do those yards need to be in effect. And so you can sort of see up here, you've got sort of a lot more building per sort of acre, if you like, compared with the size of the sites. And that's really kind of what's interesting here, is you've got quite a big site in effect that's got a much smaller building. That's kind of where my eye was naturally drawn to that particular property. I guess as you sort of zoom around, you kind of notice some of these things here, and perhaps even up here. You know, do I need such a big yard to the side of this particular property? Do I need, this is kind of clearly quite highly developed, but actually perhaps on the end there it's less so. And so that sort of kind of interesting as well. Look at this, got this big long yard at the back of that particular property. So you have this sort of very simple way of sort of viewing the world, and almost saying, well, actually, you know, could I extend at the back of that, and sort of some drawing tools and stuff that can kind of make all of that interesting. But again, it sort of becomes very easy to see, well, where are those buildings that could cope with an extension? And again, kind of up here, I sort of feel like, you know, you've got this big property here with not huge amounts of land around it, and yet over here you've got some much bigger yard space around that particular property. You almost feel
the flip side is probably, so that one there, you've got that business centre there. If that's a multi-let business, it looks like they've carved a unit out of that, actually, haven't they already? They've sold one off.
Yeah.
But you know, you can click on that, and then you can see, well, you know, if I was interested in multi-unit estates, then you've got a company there you could go and approach if you want to say, look, I've got somebody that wants that kind of you know, 1.28, 1.12. I don't know what the commercial size of that setup is. It's, you probably can see in the, you know, it's 14. Yeah, so you've got all the square footage. So yeah, it just gives you a kind of a feel for, you know, if there's something out there that you might want to go and approach. There's lots of little multi-let sites there that you might have underbidders. Say you've sold one site and you've got 9 underbidders, well, go and potentially knock on the door. You've got buyers with cash. You know, you just need product, don't you?
Yes, this is one of the things that we sort of recommend agents to do, is that when you look at the, you know, so if I'm selling this or selling this or whatever, I get 3 or 4 people bidding on it, and especially with Ben's kind of thing, it's very likely to happen, I guess, if you get a good marketing campaign out there. The kind of question then goes through your head, well, if I've got 4 people want to buy this particular building, are there a bunch of other people, you know, there's kind of the other 3 aren't going to be able to buy it. So are there any people around this area that actually want to go and sell their buildings that are there in effect? And so what we can do is we can reset this and say, well, just show me all the properties that are industrial use in that area. In effect, reapply that, and then we have this thing called workflow that just kind of powers a letter engine in effect. So you can go off and you can add all that search into your workflow in effect.
You've got that button at the top, haven't you? You can add the whole of that search into your workflow. That goes, then you can export that into an Excel file, and then you can work through it and send some mail campaigns out and stuff like that. Either you or you.
Yeah, absolutely. So that's in effect the way you do. You click save, puts all that stuff into a thing called workflow. Then from there, it will then give me a download of that in Excel, where I can then go and write. So it's plotting all these little pins on the map to say that I've got those saved in a section on my workflow called opportunities, which actually this one here, you can see all these sort of properties, the Birmingham one there and this sort of stuff. There's kind of loads. I've got 255 in there actually. I've just done the same thing in Bristol actually for you can
export that and do it and easily do a mail merge off those, just those directly.
Exactly that. It just brings the ownership detail through to be able to give you a mail merge of that. So
of course,
just I
think just as an extra, if it's so to note, so if half of them are in private ownership versus corporate ownership, obviously you get the corporate ownership. If you want the private ownership, then you can mass download your office copies. We store that with that for you, so you've got the, you know, £3 to £3 is just a disbursement, and then you've got those, and we've populated into the mail merge for you, so it saves it. You know, it's Mr. and Mrs. Jones is saved into your workflows for future use as well. So you've got all that available to you. But okay, I'm just very conscious, Paul, of
yeah. So I'm gonna be quiet now, and
it's 3 o'clock. I'm just going to sort of maybe do a roaming mic, Paul, and see if there's anybody that wants to ask us any questions. We've answered a couple of them already. I think Neil's answered one.
Yeah, sure.
But maybe you could just perhaps help us and get a bit of a virtual roaming mic.
So if anybody would like to ask a question on the on your control panel on the Zoom controls, there's a raise hand button. If you could click that for us, that will tell us that you want to ask a question. We can then unmute you. You can ask the question to us live, and then we'll answer that for you now. So Suki's got a question. Let's see if we can bring you up, Suki. I'm just going to ask you to unmute yourself if I can.
Yeah, hi guys, how you doing?
I'm fine. How you getting on?
Well, how you doing?
Very well, thanks. Very well. Excellent presentation, guys. Thanks for that. A question really for Neil, I suppose. Typically, Neil, what sort of lease durations are you now seeing?
Predominantly it's 5+ years, and that's on existing buildings. New buildings, early part of this year, there were deals being done with breaks at year 10, and there are still deals happening on that basis. But invariably, if it's a fund institution got involvement, then it's 15+ years, and those deals are happening. But on the second-hand buildings, invariably it's 5 years and above. Smaller stuff, if there's flexibility, whereas you may have done 12 months historically, it's now 3-year breaks. But across the board, lease lengths are being pushed out.
Okay, so in terms of when the funds get involved, and when you're sort of talking the blue chip sort of occupiers, purpose built, I mean, would you consider anything sort of 20, 25 years? Would you consider that to be excessive or achievable?
They are being done. I mean, invariably it's 15 years. I think that seems to be the benchmark for what it's expectations, really. Not to say that the market or occupiers won't sign up to 20 years. You know, we've done a deal on 60,000 square feet, second-hand, refurbished in Birmingham. And the expectations are we will get 10 years, we got 20. And that was occupier driven. They wanted to tie themselves in for that long. And conversely, we are actually seeing now a drive from occupiers to approach landlords and cement themselves into leases because they're nervous about supply going forward. So yeah, 15 years is the benchmarking lease duration, but yeah, if you wanted to quote for 20 years and look for 20 years on certain types of property, then it's not unachievable.
No, that's fine. That's great. And a final question on that. Sorry, is that on a sort of disposal of you know, from an investment point of view, typically if you were to get, say, a blue chip client on, say, a 15-year lease, well, what sort of yield do you think you could achieve from a disposal point of view?
If it's a good quality new building, say blue chip tenant, and your Midlands, it's in the region of 3%, 3.25%, I would imagine at the moment.
Wow.
Yeah, it's booming market. All right, guys, thank you very much. Really appreciate that.
Quick question from me. Are you seeing any sort of, is it all open market rent reviews on those 5-year patterns, or are you sort of seeing kind of RPI, CPI collars or anything like that? Like we see a lot of that in the convenience market on a 15-year lease. Are you seeing any of that, or is it open market?
It's interesting, actually. We've had a couple of conversations in-house today in terms of what we do 5 years away reviews, because such bullish rents are being paid today, which are, you know, over and above, you know, if you say on a industrial estate, you know, the rental tone on one deal is being pushed by some degree.
Yeah.
You question where the market will be in 5 years' time and whether there will be much reversion on the rent that you're agreeing today. You know, how far will the rents grow? So landlords are, you know, trying to cover all bases, and the higher of open market and, you know, collar and cap of 2 and 4% for RPI. Some tenants are actually trying to fix their rents, you know, by insisting on an RPI or trying to fix it for today, that landlords just not having a in the main, landlords don't want to be doing that, of course, and landlords don't want to take the open market away from the table in 5 years, because clearly if we continue to grow anything like we've seen in the past 12 months, yeah, pretty much anything at the moment is reversionary, unless a deal has been set in the last couple of months. Deals at the start of this year even are reversionary. If you've got a scheme that is 6 and 9 months away from delivery, landlords invariably are holding back on quoting rents for fear of actually agreeing a deal today, and by the time it's completed, it's reversionary. We haven't seen many day one rent reviews, but it's certainly been spoken about.
That's correct. So they are the landlords and the holders. They've got an upward only rent review on a 5-year pattern of 15-year lease, I'm assuming, but they're sort of saying, I'd rather gamble on the upward rather than sort of having an RPI collared sort of guarantee that of a rental increase.
Times are changing. I think it's caught everybody out the market, you know, from landlords, investors, occupiers. I think the landlords and the investors have been caught out in a positive light, I think from businesses, it's, do you stick or twist? Do you commit yourself to a rent that you're going to be going up by a minimum of 2% compounded for the next 5 years, or do you risk what could happen in the market? It is that crystal ball gazing.
Well, if you're saying 750 a foot can go to £10, so that's a 25% increase. RPI is not going to double, go to that sort of level, is it? Over, well, they're talking about inflation going up, but it's not going to go to that sort of level even on a compounded basis in 5 years. So
you wouldn't have thought so, but in terms of what's happened in the past 12 months, I wouldn't really want to second guess where the market's going to go. But it's the projections are that it's going to grow by some degree. We're not looking at a cooling off in the
well, as you say, it comes back to your existing cool stats, isn't it? You're not saying these cool stats are staying at that sort of 300% increase on last year. They are not, the inquiries are not going away, are they? So that's that sort of underlying sort of frothiness.
If you look from an investment perspective, the amount of money coming into the sector from from funds, the yields that are being paid, and if you're at, say, 3% in Midlands, you're sub 2% in the southeast on certain industrial deals. Now that strength is not for the next 12 months. That's a longer term view. So investors are taking that longer term view, investing into that sector, into the logistics industrial sector. The money going in from developers, the pipeline, trying to find sites, strap land, that is at the very worst, it's a medium term plan. So for the next 5 years, we are expecting at worst stability, at best growth. To what degree, we're not quite sure, but it's an upward trend.
Yeah. It's just how upwards. Yeah. So I've kind of jumped across all of our things, but was there another? Sorry, I do apologise.
Yes, we've got. I think Ian was next. Let's see if we can get Ian to unmute himself.
Yeah. Can you hear me now, Paul?
Hi, Ian.
Yeah. Yep.
Hi. Just a quick one. This new thing coming out on Nimbus Maps. That's what the average commercial yield, is it, or the commercial value per square foot?
Yeah, so the new thing is the commercial comparables. So there's the new residential comparables, similar sort of setup. The new commercial comparables are going in as part of this new release, which is due sort of early part of next week. So then you'll be able to kind of plot all the commercial sales across the map. It will show you sale price. You can switch between sale price and rate per square foot. Really kind of help you pin down, in today's case, what have sheds historically sold for in those areas. We've then got the commercial availability, which then would kind of drive you at the kind of growth that Neil's talking about, sort of seeing what are those quoting prices, if people are prepared to quote, of course, is the big question, isn't it, really? And so the combination of both of those two should give you that really clear understanding of what the commercial values are and what that commercial marketplace is doing.
Right. And is that all included in the general elite package? It's not a... It is, right.
I think probably it's an appropriate time just to say, Ian, that we've got a Black Friday event starting on Monday as well to tie in with the new release. So we've probably got the most, one of the best deals we've done, I think, for Black Friday. And then if you get a second license, it's half price. I can send you the details. I mean, there is a slide on that, isn't there, Paul? But we're sort of tying up the new release with our Black Friday events that's starting obviously on Monday. So now's the time to lock in that kind of deal, and it's all those comps are coming out with quite a few extra bits, which we are super excited about, actually. So
right, sure. But I mean, the new thing will be part of included in the normal elite package. Yes. It won't be an elite plus or anything. No. Okay, that's fine. So should I just find that sort of as of Monday that will be in my system, or because I'm an elite plus?
Yes, you certainly should do. Yes.
Right.
It may be that it doesn't come out on Monday. There's one or two things that I'm making go back and improve again. So I'm sort of I'm getting my OCD out a little bit because I want it to be absolutely spot on when it goes out. So it may drift into the middle of next week.
It should be released on the Sunday, overnight on a Sunday when it's quieter. But our perfectionists, we kind of wanted to get it right. Keep doing stuff. When do you do it? But anyway, it'll be very soon.
Right, and that will be found under overlays, will it, or under?
Yes, it's under the new location analysis tool. So it's sort of the new home for overlays, and there's kind of some of the exports are moving into it as well. So it's kind of a new tool we're creating.
The customer success team are putting together a whole kind of package of information about the release, which you'll get information on. So they're working on it now. It won't just be dropped in. It will be, you'll be forewarned about it. I think
Right.
Just trying to top and tail the final bits, really. So.
Yeah. Okay. Right. Thank you very much. It's very helpful.
The wry smile. There's always a battle between getting it out and getting it out.
Yeah, of course. Yeah, no, understand. Cheers.
Right. We do have one more question, which is from Michael. To see if we can get Michael up and see if we can ask you to mute yourself, Michael.
Oh, hello. Yeah. Hello. Can you hear me?
Yes, can you? Yeah.
You can. Oh,
Yeah,
good. Yeah. It's just a quick question regarding the 5-year on these units. Are they including FRIs or is that because it's just a short term? It's less than 5 year or 5-year term. So the landlord's responsible for full repair covenant, repair and maintenance of the site.
No, the tenant, the FRI, full repairing insurance, the tenant pays for the repairs. So as if they've got the whole building, they've got to reinstate it back to the original.
Oh, okay. But even if it's 5 year.
Yeah.
Oh,
yeah,
okay.
yeah. I mean, I've only ever been involved in internal repairing leases maybe twice in 15, 20 years. So invariably it's full repairing insuring leases is market standards, subject to landlord's position, age of the building, specification, likely to be a scheduled condition attached to that to limit the tenant's repairing covenants. But yeah, full repairing leases are standard.
But I guess the landlord's strength, you could probably tell them that's it, you just reinstate it back to the you took it on, isn't it, really? But yeah.
Okay. Yeah, there's very little in the market that landlords have to concede to at the moment. Very little.
Oh, that's good. That's great news. The second question is probably to Paul. You know that you mentioned about the SPON that you use the data for. How up to date is that in terms of the material and labor costs?
Question. That's a good question. So it's SPON's latest book. We've had some pretty high inflation rates recently. So So I'm guessing there could be a little bit more growth we put into that as part of the that. There's been some pretty big changes in there sort of recent in terms of materials and this sort of stuff. So
there's huge flux in the market at the moment. So I'm sure many on the call will know better than I. But we've been speaking with various developers in recent weeks. And they've gone to tender on different types of industrial, different sizes in the Midlands. And there's a relatively wild swing between sort of £75 per square foot, the lower end, up to north of £100 per square foot on buildings of a relatively similar size. And that is, significantly over and above where we would have been but a few years ago. And we've got lead-in issues as well on materials. We've been quoted 5 months for composite cladding. Big problems in terms of getting buildings out the ground from a cost and timing perspective.
Yeah. Okay.
I just wanted to perhaps just give you a quick slice. This is what Simon was talking about a moment ago. So we have a Black Friday offer here at Nimbus. This is launching on the 22nd, which is Monday. So if anybody would like to take advantage of that, the discount on the Elite annual subscription, there's actually a discount on the monthly one as well. And those discounts also apply to the Elite Plus system and of course the Elite Max system too. So if anyone would like to take advantage of that, there is a link here which we can pop into the chat. So I don't know if I can perhaps get you to pop that into the chat for me.
I was trying to get that off the slides. I'm struggling to sort of find that off the slides, but
I'll just typing that if you could. So it's https://bit.ly/call with a capital C, the Nimbus team with capitals. That's okay. We'll pop that into the chat for you now. I think so perhaps if I can get you to do that, that would be great. Just checking the questions. I think there is one final question. We got time for another question, Simon? Or we?
Yeah, go for it. I think people are still around. There's still some.
Fabulous. Let's. So Stuart's got a question. Stuart McGregor. Let's just see if we can ask you to unmute yourself. Hi, Stuart.
Has that worked?
Yeah, that has. Yeah, absolutely. How you doing?
Excellent. Full of the joys. I'm actually the parking services manager for the City of London. So I joined this thinking it was a different seminar, but I've been absolutely fascinated by all of it. It's international.
I've got a ticket actually. That's what I was worried about.
There you go. But I was thinking that it might be about logistics and sustainable transport around depots. So my question is, where you're starting to mix residential with commercial, how do you manage I wouldn't like to be beside an Amazon hub, if you see what I mean, but I would love to be beside a logistics hub where there's little electric bikes coming out. Is that part of the consideration when siting places?
In terms of, I mean, this is where it would be nice to have a developer on the call, but my experience in the market at the moment, just seeing where the market is moving to, developers are very much aware and looking to deliver on new opportunities that tick boxes on green credentials, whether that be, for example, we've got a site in Coventry where the owners or the developers have brought in electric to the site that is from sustainable sources, renewable sources. We've got developers who are not bringing in gas to sites, for example, for new schemes. There are no limitations in terms of who the tenants may be to those buildings, but for example, you mentioned Amazon, they are quickly shifting over to electric vehicles. Developers are considering well-being as part of the offering in their properties. So I say woodland settings, but landscaping, even urban sites, paths to walk and exercise. We're seeing all sorts, gyms, cycle paths. All of this is being considered where possible. Certainly schemes that are in more perhaps semi-rural locations or motorway boxes where you've got more land, those considerations can be offered with relative ease. When it's more of an urban context, there's only so much you can do. But yeah, it's going one way, and that is sort of the way that you're perhaps looking for it to go.
Excellent, thank you for that. Very interesting presentation. I've learned a lot, particularly around acronyms like SPON, which I had to Google. But
that's the bane of Paul's life. There's acronyms everywhere, isn't there? Everything, but it's but okay.
My life trying to work out what they mean rather than actually thinking about what's being said. So apologies.
Well, we've overrun ever so slightly, but I'm always fascinated and to sort of learn these things. You always learn something new every time you come on a webinar. But first of all, I'd love to thank Neil for his time again. Really, really interesting. And so thanks, Neil, for your time this afternoon. And finally, I'd like to thank the audience for watching. I thank Paul as well. I always have to thank Paul, but I get to quite a lot. I have breakfast with him most mornings. But yeah, so thanks, Paul, very much for your time as well. And thanks very much to the audience for listening. We've been Nimbus Maps. We're here to help you succeed in your property goals. Thanks again.